If you want an exposure to a market or an
Everything they need in one place.
The world's foremost authority on individuals, advisors and institutions.
Today we're talking about how the average man on the street can better invest. Joining me today is former hedge fund manager and now author of How to Invest books, Lars Kroijer. Lars, thanks for joining me.
Thanks for having me.
So you've just written a book that is called Investing Demystified, How to Invest Without Speculation and Sleepless Nights. In a nutshell, how do you?
Well, so in the book I start with the premise of who are you? Who are you as the investor? And I argue that the vast majority of investors have no real prospect of having an edge to beat the markets. So what does that mean? It means that you will, as an investor, in all likelihood, not be able to make a security selection, so pick stocks or index funds or anything, the active funds, better than the market as a whole. And you shouldn't even try. So that's the premise of the book. So
you would say 100% passive fund investment, no active funds in your portfolio at all?
Absolutely right. I'm saying you should, if you don't have the prospect to beat the markets, and you in all likelihood don't, buy the broadest, cheapest index funds you can get your hands on. So specifically, if you stay with equities for a second, I'm saying you should buy the World Equity Index. So that's an index that comprises of as many equities from across the globe as you can possibly get your hands on. You should do that as cheaply as possible, as tax efficiently as possible. And for your equity portfolio, that's all you should do. Now, why is that? It's because anything else would somehow imply edge. It would somehow imply that you have the ability to pick something other than what the market's picked. And I'm arguing the vast majority of people don't have that.
But of course, this is where Morningstar comes in. You know, our analysts rate funds, and analyst ratings are trying to say whether or not a fund will outperform its peers going forward. So a lot of people would argue, say, in certain areas like emerging markets, for example, that active fund manager, you need that extra expertise to make the educated decision. Are you saying that you disagree with that?
Well, I'm not saying edge doesn't exist. It's very important, right? As a former hedge fund manager, I would be a huge hypocrite if I said that. I'm saying, who are you to have that edge? And whether we're in the emerging markets or in the UK, are markets any less efficient in places like India and Brazil and so forth than they are here? Some people would argue yes, some people would argue no. But let's go to India for a second and say, well, do you have an edge in India? Does my mom have any realistic chance of picking Indian stocks different from what the quite active market of investors in India picked? And I argue she doesn't. Does she have the ability to somehow magically pick the active fund manager who would beat the Nifty 50? I'd argue she doesn't. Do some people? Sure. Most people don't. So don't try, because it's expensive to try. You're going to be worse off in the long run picking active managers than you pick a passive manager if you don't have the magical ability to pick the superior performers.
And in the book, actually, you illustrate this very well, the difference between over a lifetime of investing actively versus passively. Yeah,
so the example I have in the book is, and now we're back in the UK, is an average saver who makes £50,000 a year, puts 10% of that aside every year and puts it into the equity markets. Okay, let's say that person does that between the ages of 25 and 67, so that's a normal working lifespan. And let's further say that the stock markets perform much like they have historically, so about 4.5–5% above inflation. The difference at retirement for that person between having picked a passive fund, that's called a World Equity Index, and an active fund that tracks the same thing, the difference in fees will amount to almost £300,000 in today's money. So provocatively, I say that's the equivalent of 7 Porsches. Right? So essentially, I'm saying that the average saver, someone who makes £50,000 a year, will over a lifetime pay the equivalent of 7 Porsches to the financial sector, right, for a product that does the same thing, or very close to the same thing. In fact, I would argue the passive product is better because it's better diversified. So even if you didn't have the fee advantage. Now that's crazy, right? So I'm saying for you to not do that, you have to have an amazing ability to pick just the right fund manager, not trade, not pick stocks yourself. Now most people don't have it. Now, when you compare that to someone like myself, who was a fund manager, and not only did I have access to real-time information, I had the best minds in finance working for me, I had the best software, I had the best information, I was the first one to get the call back from the companies we invested in, and I did it as a full-time job. Right? What chance does my mom have compared to that? And I thought it was hard. I thought it was very, very hard, and I'm skeptical whether a lot of people that do it for a living have the edge, but people that don't certainly don't.
So to sum up then, for the average person wanting to save for retirement, you say go 100% passive, invest in the whole world stock market, assign bonds, I assume, according to your risk profile, and stick with it for the long term.
Yeah, I'm certainly not advocating anyone should put all their savings in equities. Equities are extraordinarily risky. But I'm saying for the equity portion, do just that. It's very, very simple. It's very, very cheap. Do it tax efficiently. Of course, don't only do that in the book. A big part of it is actually what you should do with a less risky part of your portfolio. But for the equities, that is that.
And then, of course, to give a little plug to Morningstar here, we have just started rating trackers, actually. So the analysts there are looking very closely at passive funds as well as active funds.
Yeah, and I think that's a huge service. And I think it's very, very useful because much like active funds, there's a huge industry of passive funds. They're not all equally good, and the world needs a service like that. And I'm glad you guys are doing it.
But ultimately, would you say lowest cost is the best kind of pointer to look out for?
If you don't know better, yes. You mean there are many ways that these index trackers can charge you money. There are issues of collateral. There are issues of do you own the underlying assets? Do you not? Synthetic versus physical, stuff like that. But if you're my mom, if you go with the lowest cost product, that's a good start. Make sure it's big, because this is one of these things where there's huge benefits of scale, which is why the large index providers or index tracking providers will tend to do better. But absolutely right, make sure you go cheap.
Great, well thank you very much for that. It's a good overview of how the average person on the street should invest.
Well, thanks for having me.
For Morningstar, I'm Holly Cook. Thanks for watching.